Japan just can't catch a break. Over the past few months, the land of the rising sun has dominated financial headlines, and the news isn't exactly rosy. Things are so dire that former Prime Minister Shigeru Ishiba recently stated, "Japan is as broke as Greece was during its financial crisis." And when I say former Prime Minister, it's because he was forced to step down after a disastrous election, heavily influenced by the country's dire economic situation. After decades of stagnation, just when it seemed Japan's economy might finally take off, bam! The perfect storm hit. We've got all the ingredients for a disaster: soaring inflation, skyrocketing public debt, rising interest rates, a political crisis, and a central bank that's done pouring fuel on the fire. Here's a stat you can't ignore: Japan is the world's most indebted developed economy, with a public debt-to-GDP ratio of 260%. That's like taking out a loan to hit the casino. If you win, great. If you lose, you're twice as broke. And we're not talking about just any country. This is Japan, the home of Nintendo, anime, samurai, and the world's fourth largest economy. A critical cog in the global financial machine. If that cog breaks, it could drag the whole system down with it. But let's pump the brakes for a second. No need to sound the alarm just yet. Yes, Japan's problems are serious, very serious, and they're getting worse by the day. But it's got a couple of aces up its sleeve, and all hope might not be lost. That said, let's dive into today's big questions. Why is Japan's debt interest rate spiking? What does this mean for the country? Can it be fixed? Stick around, because we're breaking it all down. First up, is Japan really as indebted as they say? Well, not exactly, or at least, not in the way you might think. For starters, nearly 80% of Japan's public debt is held by its own citizens. That's a big difference from owing money to the rest of the world. Even more striking, half of that debt is held by the Bank of Japan, BOJ. But hold on, because here's the kicker. When you hear that Japan is the most indebted developed economy, what's being compared is debt relative to GDP. Sure, that number sounds scary, but it doesn't tell the whole story. Let's look at an example: Vladimir Putin's Russia. Its public debt is only 16 to 20% of GDP, 7 times less than the US, but guess what? Russia spends 3.5 times more of its budget on interest payments than the US does. Why? Because borrowing is insanely expensive for Putin. It's not like Russia's some model of Swiss fiscal discipline, it just can't borrow easily. Japan, on the other hand, is the opposite. Borrowing is so cheap that the government can afford a sky-high debt-to-GDP ratio. In fact, Japan only spends about 8.5% of its budget on interest payments. Plus, unlike many countries, Japan is actively paying down the principal, dedicating nearly twice as much to that as to interest. Does this mean Japan's debt is no big deal? Not at all. The land of the rising sun has problems, big ones, and they're getting worse. But we need to put things in perspective. In a recent video, we broke down what's going on in detail, and understanding this is key to grasping why the situation is getting tenser by the day, and what Japan can do to avoid a total meltdown. For those who haven't seen it, here's a quick recap in 3 key points. First, we mentioned Japan's massive debt-to-GDP ratio. But as we've seen, the real cost of that debt isn't as bad as it sounds. What we haven't told you yet is that Japan isn't just a debtor, it's also a major creditor. In fact, it's one of the world's biggest lenders. Get this, Japan, with its 125 million people, holds more US Treasury bonds than China. Yes, you heard that right, the land of sushi and karaoke owns more American debt than the Asian giant. How? Japan's economy is wildly unbalanced. Its industrial sector has historically been a global powerhouse. Think Toyota, Sony. Back in the day, they scared the US so much that Ronald Reagan, the free trade champion, slapped 100% tariffs on them. But that strength came at a cost: a weak services sector. This imbalance tilted Japan's trade balance toward exports, bringing in far more dollars than it spent. So, what did the Bank of Japan do with all those dollars? It bought foreign debt, mostly US treasuries. That brings us to the second key point. Since the 1990s, the productivity gap between Japan and the US has only widened. What was once an economic miracle turned into decades of stagnation. The government's response? The classic playbook: issue tons of public debt and keep interest rates near zero, or even negative. The Bank of Japan played a huge role here, buying up half of all government debt, which kept borrowing costs low. Insurance companies and pension funds also snapped up Japanese bonds like crazy. But now, the BOJ has gone from the government's best friend to its biggest headache. Why? It's done buying debt. Japan's facing 3.5% inflation. By its standards, that's a 5-alarm fire. Continuing to buy bonds would be like pouring gas on the flames. Until recently, the BOJ bought bonds to boost demand, making it dirt cheap for the government to borrow. But that's over. Nobody's stepping in to fill the gap. Remember those insurance companies? The Big Four reported $60 billion in bond losses last year, 4 times more than the year before. Naturally, they're not eager to keep buying. Foreign investors, who were big players earlier this year, are also bailing. The result? Interest rates on government debt have spiked to levels not seen in decades. Quick explainer, the interest rate on debt is what the government pays to borrow money. The higher it goes, the worse it is for the government. Check this out, the 40-year bond started the year at 2.6%. Now, it's at 3.7%, and nobody's biting. You might be wondering, if the BOJ is stepping back to avoid overheating the economy, why isn't the private sector buying up this debt? Great question. Historically, Japanese insurers and pension funds parked money in dollars because Japanese bonds paid next to nothing. They still bought plenty of local debt, but they also hedged with US assets. Now that Japan's rates are no longer zero or negative, you'd think demand would pick up. But debt auctions keep failing. Why? That's our third key point. Japan's had it rough for decades, but now it's in deep trouble. For years, the country dreamed of escaping deflation. Be careful what you wish for, because now Japan has inflation, but no economic growth. Prices are rising, but wages aren't. And then there's the rice shock. Yes, rice, the staple of every Japanese table, has doubled in price. Blame a mix of bad harvests and worse government decisions. The opposition demanded that Ishiba lower or eliminate food taxes to ease the burden, but he was stuck between a rock and a hard place. Cutting taxes would mean less revenue, making it harder to service the debt and driving up interest rates. Keeping taxes high fuels inflation, social unrest, and political instability, which also spikes the risk premium. Either way, Ishiba was doomed. He chose the tax route, and it cost him his job. Here's the critical part, the market isn't just worried about today, it's terrified of tomorrow. The gap between 30-year and 10-year bond yields in Japan is growing faster than in other countries. Sure, the rice crisis is temporary, and 3.5% inflation might ease. But what happens in the next crisis? And how will today's problems affect long-term growth? Japan's real Achilles heel is its aging population. Its per-worker GDP growth is world-class, but it doesn't matter if the workforce keeps shrinking. Winter is coming, and with it, the usual suspects, debt and interest rates. Speaking of rates, they're a bigger deal than you might think. Japan kept interest rates negative from 2016 to 2024. Just raising them to 0.25% last year caused a financial earthquake. Now they're at 0.5%. These are central bank rates, not the same as bond yields, but they're closely linked. With ultra-low rates, the government played a financial game called carry trade, borrowing short-term to invest long-term, often in stable foreign currencies like the dollar to maximize returns. It's not unique to Japan, but Japan's scale is unmatched. Until now, it's worked like a charm. The problem? If the carry trade stalls, those profits turn into losses, and the debt piles up. Plus, low rates benefit the elderly, who hold long-term bonds and rely on pensions, but they screw over the young, whose savings earn nothing. This is called financial repression, when a government sacrifices one group's economic future to fund itself. Raising rates would cool the economy and hurt seniors' purchasing power, forcing the government to either raise taxes, tanking the economy further, or let pensioners suffer, political suicide in an aging country. If this spiral continues, Japan might have to sell its US Treasury holdings to plug budget holes. As the largest foreign holder of US debt, that could flood the market, crash bond prices, and force the US to hike rates, triggering a recession. When America sneezes, the world catches a cold. But here's the twist. Japan only holds 13% of US foreign debt, 3% of total US debt. Even a full sell-off wouldn't cause long-term chaos. More importantly, Japan's pension funds and insurers, which chased foreign bonds for better returns, will likely bring their money home if Japanese rates keep rising. Higher demand for Japanese bonds would lower yields, stabilizing the market. So, yes, Japan's in a tough spot. Its finances are stretched, and borrowing costs are soaring. But the repatriation of Japanese capital could keep things under control. That's not a magic fix, though. The aging population means social spending is eating up the budget, leaving little room for error. As Yoda might say, no margin leads to instability, and instability leads to the dark side. Debt, in other words. Now it's your turn. Are Japan's problems temporary, or is there a deeper issue? Can the government balance its books without crashing the economy? Could Japan's trouble spread globally? Drop your thoughts in the comments. We post new videos every week, so subscribe if you haven't already, and give this video a like if you found it helpful. See you next time.